We're currently experiencing a time of uncertainty in the stock and bond markets, both in the United States and globally. This might leave you wondering, is the market going down right now? What should you do if it does? Looking at history can be helpful as you seek answers. After the 1929 stock market crash, many people were deeply affected, and it took until the 1950s and 60s for a new generation to emerge without the scars of 1929, rediscovering the stock market. This reflects how traumatic events, like market crashes, can shape us. While the 1929 crash and the subsequent Great Depression were extreme, today's investors will also encounter market downturns from time to time. There are key things to keep in mind during those times. But before we delve into that, be sure to subscribe to our Finance Hub channel and hit the bell icon to stay updated. Don't panic. Remember, it's important not to get stressed when the stock market goes down, as this happens regularly. The Schwab Center for Financial Research says the market has a correction, a decrease of 10% to 20% about every 2 years, but don't worry too much about that. Over the 20 years from 2001 to 2021, the market usually bounced back fast after these drops. Despite some setbacks, most years showed positive returns, with an average gain of about 7%. Looking at data since 1950, the research found that these market corrections happen about every 2 years. Many of them last less than a year, 32, and even more last less than 4 months, 24. So, although market downturns are normal, history shows that the market tends to recover quickly. Staying calm during these times is key to successful investing. Don't focus on price instead of value. When the stock market experiences a crash, it's common for people to monitor stock prices closely. You might observe a particular holding's stock price taking a 25% nosedive, or hear news that the Dow Jones Industrial Average, which reflects the stock prices of 30 major companies like Apple, Nike, and Walmart, has plummeted by 10%. While this may cause your heart to race, it's crucial to pause and ask yourself whether these companies have genuinely become 25% or 10% less valuable. In most cases, that's not the reality. The decline typically affects only the stock prices and is likely temporary. Of course, there are instances where stocks may decrease in value for valid reasons, such as posting poor quarterly results or being entangled in a significant issue like an accounting scandal. In such cases, you may want to contemplate selling, but only after thoroughly investigating whether the problem is a short-term challenge or a lasting concern. It's crucial to assess whether you still have confidence in the company's growth potential. Don't take a break from investing. It's important not to sell your stocks when the market crashes hastily. Instead, take your time, whether for a short or long time. Market crashes can bring excellent chances to invest, especially when the stocks of great and growing companies are temporarily available at lower prices. For better investment outcomes, be prepared for occasional market downturns. Stay calm and be ready to take advantage of opportunities if you can. Consider keeping a small part of your investment money in cash, specifically for these opportunities. Additionally, maintain a watch list of stocks you'd like to buy when the time is right. Suppose you regularly set aside a significant part of your paycheck, 10% or more, into your investment account with a reliable brokerage. In that case, it can help ensure you have cash available for such opportunities. Pay off debts. If you have a lot of debts, it might be a good idea to sell some or all of your investments and use the money to pay off those debts, especially if you think the financial markets are about to get rough. This is especially wise if you have a bunch of high-interest debts like credit card balances or other loans. Doing this gives you a more stable financial situation, even if the market isn't doing well. Another smart move could be paying off your house or a significant part of your mortgage. It's always a good idea to reduce your monthly financial commitments. This way, you'll be in a better position even when the economy isn't at its best. Top of form. Find the silver tax lining. If your investments take a hit and you can't shield them directly, there are still ways to soften the blow. One way is through tax loss harvesting, especially for losses in taxable accounts. Here's a simple idea. 1. Sell off the lost value investments, then wait at least 31 days before repurchasing them. 2. Make sure you sell before the end of the tax year, by January 1st, and then you can repurchase the stocks 31 days later or more. 3. Just be careful not to repurchase them too soon. The IRS calls it a wash sale, and you won't benefit from claiming the loss. Once you've done this, you can use those losses to balance out any gains in those accounts. If your losses exceed your gains, you can carry the extra losses to the next year. On top of that, you're allowed to deduct up to $3,000 of losses each year from your regular income. It's a way to make the best of a challenging situation in investing. Consider converting to a Roth account. If you have traditional IRAs or retirement plans from past jobs that you can move around, think about turning some or all of them into Roth IRAs, especially when their values are low. This move can lower the amount you convert and, as a result, reduce the taxable income you have to report. For instance, if the value of a $90,000 IRA drops by 30%, that's $27,000 less. You'll have to pay taxes if you convert the whole balance in 1 year. This strategy is especially smart if you're not working for part or all of the year. When you're unemployed, you might be in a lower tax bracket, even after the conversion. It's a way to make the most out of the situation, especially when the value of your investments is down. A market crash can impact investments, and it's important to understand how different types of assets are affected for effective portfolio management. When a crash happens, stock markets often go down, affecting stock investments. However, the impact on other types of assets like bonds, commodities, and real estate can vary. To minimize losses and safeguard the overall value of your portfolio, it's crucial to use strategies. Feel free to share your thoughts or ask any questions you might have. If you're hungry for more finance know-how, consider subscribing to our Finance Hub channel. Don't miss out on any of our updates. Hit that bell icon and be the first to know when we drop a new video. Thanks for watching the video.